New report says that despite some positive signs in 2009, 21% of U.S. homeowners with mortgages currently owe more than their homes are worth. Online real estate leader Zillow.com put out the report that also showed U.S. home values declining 5% from 2008 to 2009. Joining us now from Seattle, Stan Humphries, the chief economist for Zillow.com. Stan, always good to see you. Welcome back to Bloomberg News.
Good morning, Mark. How are you doing?
I'm very well, thank you. Stan, these numbers really don't tell the whole story. How bad is it?
Yeah, it's after a period of stabilization in 2009 in a lot of the metropolitan markets where home values really started to stabilize. Unfortunately, we saw a lot of the momentum leave those markets, or starting to leave those markets, according to Zillow's December data, which showed that in 29 major metropolitan markets where home values had been increasing for several months in a row in 2009, they ended the year in December with home values actually declining.
Right.
Which, if those declines are sustained, as we think several of those markets is going to occur, it'll set those markets up for a double dip in home values.
Stan, you said basically the wind got taken out of the sails here. What do you see as the main cause?
Well, the main cause continues to be what we're seeing play out right now in the marketplace is really a battle between market fundamentals on the one hand and market intervention, primarily in the form of federal policy support on the other hand. In terms of policy support, you've got massive policy support in terms of tax credits for first-time home buyers, now extended to existing home buyers. The Federal Reserve's purchase of mortgage-backed securities, also substantially ramped up lending by the Federal Housing Administration, which has really provided a lot of demand stimulus to a lot of these markets. So that's what you have on the market intervention side. On the market fundamentals side, you also have equally colossal forces kind of playing out in the marketplace right now, with massive numbers of foreclosures entering into the marketplace, into a marketplace that already has pretty high levels of inventory of for-sale homes. Plus, you have mixed into that very high rates of negative equity. By our estimate, 21% of single-family homes with mortgages are in negative equity, which is a very volatile brew to have. A very volatile mix when you combine it with high unemployment rate, currently at 10%, estimated to go higher, because negative equity combined with unemployment is a breeding ground for more foreclosures.
Yeah, it ain't a pretty picture, is it? So what will these foreclosures do to home values? A lot of economists we've spoken with in recent weeks have suggested we're at the bottom of the hockey stick and we're just sort of bottoming along, but is there a risk here for a double dip now in home values?
Yeah, I think in terms of our forecast nationally, we have been forecasting for a while that at Zillow that home values nationally will continue to decline in the first part of this year, and we won't see a definitive bottom until sometime by the first half of this year. So sometime in the second quarter of this year, we expect to see a definitive bottom nationally. That means
that definitive bottom, Stan, sorry to interrupt you, how much of a percentage will it be from where home values are now nationally?
We expect no more than 5% national decline in terms of home values, but we're already down in our index. We're down 22% from peak, so we see no more than a 5% decline. So it's really, in some of these markets, we'll see further declines as well, and we'll actually see a double dip. By double dip, I mean basically two sustained periods of decline with separated by a brief period of stabilization. And some of these markets are going to see a double dip, but it's important to keep that in context. When I say a double dip, the second leg of that dip is really more of an aftershock to the larger market correction. It's not, we're not going to see a return to the roller coaster ride we saw in 2007, 2008.
Stan, we have about a minute left. Where are we seeing the most pain?
Well, the markets, I mentioned 29 markets that had already seen at least 5 consecutive months of monthly gains in 2009, only to see home values decline in in December. Those markets include Atlanta, Baltimore, Boston, Denver, Minneapolis, and Portland. So those are ones that have already started to go down. I think more worrisome, actually, is there's a set of another 21 markets which have actually didn't see declines in December, but they did see a weakening in terms of home value growth, which was already pretty weak to start with. And those include some pretty big markets like LA and New York. So those are markets that have been increasing in 2009. We're still increasing at the end of the year, but their decrease, the amount of decrease on a monthly basis was substantially weakening towards the end of the year.
And one more quick question, Stan, for you. Do these loans need to be remodified? Does the principal value of these mortgages need to be remodified to solve this problem?
You know, there is concern that, clearly the modification program of the federal government is not working as intended. We've got more than 900,000 trial modifications right now, and only a tiny fraction of them have gone permanent. So there are a lot of interesting proposals out there, one by Columbia University, where they're looking at ideas where the banks actually do a write-down, but then take some of the upside with the homeowner and the potential gains in the future. And that's a very attractive proposal, in my opinion.
And Stan Humphries, Zillow.com, joining us from Seattle. Stan, as always, thanks so much.